Hello, I'm Linda, and this is No Frills ASMR. Sorry, my throat made a weird noise. So, a couple weeks ago, I think, I did a video on how to raise your credit score. And I can't recall if it was in the comments or if somebody sent me an email asking for me to do just basics of a mortgage. And at first I thought, that's, outside of my area of expertise. But then again, so is everything else I do. So I have had 3 mortgages in my life. So I guess I know a little something. And I spent some time just kind of looking things up. And I'm going to share them with you. So hopefully you find it relaxing or just enough to occupy your mind. And if you think it'll be stressful, don't watch it. Because I understand that too. Somebody in the comments of the last video said that I should call the finance video. Somebody asked me to do finance. That's the only reason I'm doing it. It's not like I know anything about it. But they said I should call it No Bills ASMR. You know what's so stupid? I think I read that like 5 times and was like, what? I don't get it. And then all of a sudden I'm like, oh, no bills. That's funny. So anyway, this is part of the No Bills ASMR series. So we did one on how to raise your credit score. And that actually comes into play with getting a mortgage, because having a good credit score will definitely help you in getting lower interest rates on your mortgage. So that's what we're going to talk about as soon as I finish drawing this really cute house with this little tree. Okay, let's begin. I'm a little nervous about this one. Just, I'm not a math. You people know. People who watch know I can't add up 2 numbers. I can't count by 2s to 16, we found out in a recent video. But, all right, so there are a few things, basics here, about getting a mortgage. And one is you'll have your collateral, and the collateral is the home itself. So once you have a mortgage, the house is the collateral the bank uses. So if you don't pay your mortgage payments, the bank will take their collateral, which means they will take your home and foreclose or take it back. So the lender can take the property back. They own the property. They have just, is that, I guess, I don't know who, I mean, I always think of it like they own it until you, but anyway, they've loaned you the money to own the property. So it's kind of their property, right? So they can take back the property. So that's the collateral. And they're not like the mob, they're not going to put a horse head on your bed or something, which would be, they will come take your house. So you have to know that you can pay those mortgage payments. So the next thing is principal. Principal is when you pay your mortgage, you are paying a certain amount towards the principal and a certain amount towards the interest for the loan. The more money you can pay up front, like a down payment, that goes towards principal, and that will lower how much your loan is for. So just using like an easy number, if you bought a house for $100,000 and you paid 20% up front, or $20,000, then your loan would only be for the $80,000. So the whole goal is to get, to where you're not paying interest and you're just paying principal. Because the next thing is the interest. So the lender charges you money to borrow money. So they give you an interest rate. And this is where your credit score can come in, because if you have a higher credit score, sometimes you can negotiate a lower interest rate. Or if you have a bigger down payment, you can sometimes get a lower interest rate. There is also a thing called points. And we did this with one of our mortgages where we paid like extra money, which are points, and that lowered the interest rate. And I wish I remembered exactly, because it's been so many years, but I feel like we paid like an extra $3,000 or maybe $2,000 up front to have a point lower interest. And that's kind of worth doing if you know you're going to hold that mortgage for a long time, I would think. There's a point I'm just making up, so I don't know. Okay, and then the next thing you're going to have to pay is taxes. Those are property taxes. They're, for your local community. It pays for like the roads and the schools and library, all the public things. So you do pay taxes when you own a home. And that will be different depending on where you're at. And there is a thing, I didn't write this down actually, but called an escrow account. And so your lender or mortgage company will have you, I feel like mine, maybe this is different, but I feel like ours was once a year. I just don't recall exactly how it works, but you put a certain amount of money into escrow, and sometimes it can be quite a bit of money is sitting in an escrow account, and that is used to pay taxes and the insurance on your house. Now, the lender is going to require you to have homeowners insurance, because if something catastrophic were to happen, a tree falls on your house, they want to make sure that you can fix the house because they own the collateral. They have an interest in you having a house that doesn't have a hole in the roof. So they require you to have insurance. And depending on the kind of loan you have, you may have to have like insurance beyond just your regular homeowner's insurance, something called a PMI, private mortgage insurance, which will protect them if you quit paying on the house. It's like an added insurance. So principal, interest, taxes, and insurance. These are the things you're going to have to pay for. So when you think about buying your first house, just know that this makes up a good part of your payment. But these two things, depending on your taxes where you are and how much insurance you have to have on your house, they can add up to quite a bit. I think on my house, I think I'm paying like $780 in taxes and insurance. Gosh, is that right? Boy, I gotta look that up. I'm not sure. Maybe that's not right. I think it might be though. And then the principal and interest. So, yeah. So even if you pay off your mortgage completely, you will still owe taxes, and you might not have to have the same insurance you had before, but you'll still want to have, insurance on your property. So you're still going to have to pay to own a place. So that's something to consider, between renting and buying. I mean, the difference is eventually you'll have a property that you can then resell. while renting. You don't. Anyway, okay. I don't know. I hope I said all that correctly. Like I said, if you should really go to an expert. But I'm just trying to give you basic stuff. Look at it. Think of me as just like your friend telling you what she thinks she knows. All right. So now you're like, okay, I got to go to the bank and get a loan. And there are a few kinds of loans you can get. There's a fixed rate loan, which are the, I would say probably, I don't know this, but I would assume this is probably the most often used loan. It's a 10, 15, 20, 30-year loan, and you're told an interest rate of whatever that is, and that's what you'll pay the entirety of the loan, unless you refinance. But assuming you don't, that's what a fixed rate is. So fixed rate just means your interest rate is fixed. Because there is also a loan called an adjustable rate mortgage loan. And the thing with, you can get I don't even know, a 5-year, a 7-year. I don't know if there's a 10-year adjustable, but so you're basically locked into a rate for, say, the first 5 years. And then they give you a new rate for the next 5 years. And it's a risk. It's a risk because it's possible that the rate goes down. And so you're paying a higher rate for 5 years and then it goes down and you pay a lower rate. But it is also possible that the rate could go up. So it is a little bit risky. If you're buying a house and you get a low interest because you choose the adjustable, so sometimes they'll give you a lower rate to get you into it, and and I mean like no, that you're going to sell the house before the 5 years are up, then maybe that's a good plan for you, But if you end up keeping it and then they bump your rate up, it kind of stinks. So yeah, I'd say it works if you know you're going to move. I'm trying to remember. We may have in our very first house had an adjustable rate. I just can't remember. Anyway. Okay. I'll tell you about the crazy loan I got. All right. And then there's a loan called an FHA. And that's from the Federal Housing Administration. And this loan is basically if your credit score, excuse me, hold on, I gotta, I don't have a drink of water. If your credit score is low, or you don't have, like a lot of these mortgages, they'll ask you to put 20% down. And this FHA, you can have a lower credit score. You can not have to put as much down, but you are required to pay a PMI, which is the private mortgage insurance, which costs money, so you'll be paying more for the insurance. Hold on one second. I gotta get. Sorry, that's really loud. Sorry. I'll try to be very kind of quiet with this, but my throat's getting me right now. All right. So yeah, this one requires you to pay an added insurance cost, but it gets you into a loan if you have, not very good credit or don't have enough money to put money down on a house. They'll let you go in with like 3% down sometimes and bad credit. But you do have to pay that insurance because it protects the lender if you foreclose on the house. So that added, PMI insurance you're paying, it's not for you. You're paying it for your lender to protect them. Okay. This loan, a VA loan, is by the Veterans Administration. And it is specifically for military service people. I don't know what all qualifies you exactly, but I don't know if it's like families of, I'm not sure. But you go look it up. Sorry, I feel like I'm going to cough. They have no down payment, and really good, they don't make you pay that private mortgage insurance or PMI, so that saves you money. Yeah, so that's a good one to look into if you qualify. And then there's a loan called the USDA, which is actually the Department of Agriculture. And it doesn't require a down payment, but it's more for like if you're doing home improvements. And a lot of times it's like in rural areas. But it's sort of a, if you qualify for that, might be a good one too. But I would say most people are probably getting one of these two, unless they're military. Okay. So, I'm sorry. I'm wondering if I'm going to have to start over because my throat's so dry. I think I'll be okay. All right. All right. So, that's the basics of that. So you've got to show up. And you're going to have the best credit score you can, because that might help keep your interest rates slightly lower and help you get the mortgage. You're going to need to have proof of income. We're rolling our sleeves up. We're getting serious now. And they will probably ask to see bank account information, what debt you have, all of that before they loan you money. I didn't look it up. I don't remember exactly what. But let's say they say, okay, you're approved. You're approved for, oh yeah, and that's something else. Before you even start looking at houses, if you're serious, go and get pre-approved, because if you're pre-approved and you know exactly how much you're going to be able to spend, that helps you, one, in searching for a house, but also in just having the buyers take you seriously and the real estate agent. But just to get pre-approved. But let's say the bank has approved you for $200,000. This is basically telling you this is the most they think you should be able to spend. That doesn't mean that you should spend that amount. And in my opinion, you shouldn't. You don't want to, in my opinion, be living at the very tippy top of your budget. I just think that that's not a great place to be. And when you go out to look for a house, there's an old thing they used to say, and probably still do say, to find the cheapest house in the best neighborhood. And I do believe that to be true. I mean, I think in all our houses, that's kind of what we did. And try not to spend the full amount they'll give you, because they will possibly give you more than you should really afford. And the other reason is, I'll tell you why. But even if you do $200,000 and you need to put 20% down on it to get your fixed rate loan, that would be $40,000 in cash down. So your loan will be for $160,000. But know that you're going to need some cash to put down if you're doing one of the traditional loans. So you want to have your highest credit score. You're going to want to have some cash in the bank to put down. You'll want to get pre-approved. Once you have all that in order, then you really can seriously start looking for a home, because then when you're ready to buy, the seller will take you seriously if they know you have all this in order. But yeah, I wouldn't borrow the full amount they offer you. It's tempting to do that. But if you do, they have looked at how much you're getting paid. They've looked at everything, and they're saying this is the most you can afford. But you have to remember that you're going to have those interests, the taxes, the insurance, if you want to do any home improvements on your house in the beginning, filling it full of furniture, doing all the things that you'll want to do. It's going to cost you money. But even more than that, it's just the way a mortgage works is, I don't even know how to show that. I'm trying to think how to show this. So let's say you take out a mortgage for $200,000. I mean, it doesn't even matter for X amount, okay? It doesn't matter what your mortgage is. How am I going to show this? All right, this is easy. This is how we're going to show this. You're paying, okay, each month you pay the same amount in a fixed rate mortgage. Okay, let's say you're paying the same amount every single month. You're paying this amount, X. But in the beginning of the mortgage, almost all of your payment is going towards interest. So this is interest. And this down here is principal. I'm trying to think if my little thing's going to work. Okay, so in the beginning, you're paying almost all interest. And then slowly, as you pay off interest, you get down to where you're paying not very much interest. Now, assuming this is a 30-year loan, here's your principal. Slowly heading upwards. I think it's like down here until you still pay interest even at the very end of the loan. But in the beginning, you're paying almost entirely interest and hardly any of the principal. And with a 30-year loan, I wish I'd looked it up. It is well into the loan before you actually get where you're paying more principal than you are interest. So, if you take out a loan for less than is your tippy top budget, then every month, especially towards the beginning of your loan, you should make extra principal payments, in my opinion. And this could be argued because it really depends on your interest rate. Because if you manage to get yourself a 2% interest rate, then maybe you're better keeping all this. You're not paying too much interest. You can put it into, the stock market, or even right now, a high yield saving account, CDs, whatever your thing is, and make more money off it. But you have to be disciplined enough to do that. To know that any extra money you're making, you're putting towards savings and not just spending it on, new pillows or whatever. Or buying yourself like a higher end car where you're paying more car payments, things like that. The kind of loan that I got in 2004 was crazy. The kind of loan I got is what caused the housing crash in 2008. And it was called a no-doc loan. Now, I was a waitress, and a lot of my money, how do I say this, was in tips. And so my income was not what they wanted for a regular loan. And at the time we moved from one state to another, we sold our house in the first state. And so we did have some cash to put down. But with a no-doc loan, they didn't ask for any paycheck, any proof of employment, any bank statement. They asked for nothing. And I think it was going to be a 7% interest. But because we had some cash from the sale of our house, we paid a point. We paid something towards points to get it down to 6%. I think that's right. So our interest was 6%. And I'll tell you what, over a 30-year period, that adds up. And there are these mortgage calculators you can use. You can go look up mortgage calculator, and they will ask you, whoops, what did I just write when I'm talking and writing? Your principal balance owed. I think this is what they ask. And they'll have like a little box, and you put in how much. And then your annual interest rate, and they have a little box. That's probably not the abbreviation for that. What is it? AR? AR, annual interest. I don't know. Anyway, interest. How many years remain on the loan? Anyway, and I think that will tell you how much you're paying in interest. And then you can put in like early payoff, and you can put how many years you'd like to pay it off in, and frequency of extra payments and all that. So those are kind of useful, those mortgage tools they have online, just to have an idea of what you're paying. But basically what I'm getting at is at the beginning of your loan, you're paying almost all interest. So if you're kind of a young person who has some extra income and you just bought a house, maybe don't right away go, I got to redo the kitchen, and I got to redo this, and I got to spend that beginning time, the first whatever, making as many extra payments as you can. This is my opinion. I know there's some people say don't ever do that, put it all in savings, but this is my opinion. Towards your interest, and that will get you closer and closer to where you're paying off more principal than you are interest. If you can manage in the beginning getting a 15-year loan instead of a 30-year loan, they're just different loans. So a 15-year and a 30, I mean, those are kind of typical, right? So if you can get a 15-year loan, you're going to be making more payments will go towards your principal. To principal. And it makes a difference in a hurry. So, like you can imagine with the 30, this same chart basically, either you're not here until year 20, or you're here at year 8. So you're paying more per month with a 15-year. You're paying more monthly. This one you're paying less, but you're getting closer to paying your principal and building equity in your house. So after 5 years, you have like 3 years more of equity paid. Does that make sense? I don't know, something like that. Something like that. So I just think if you can afford, if they have okayed you for a certain amount of money, say to them, well, okay, but I'd rather do it in 15 years, so I'll take out a little less money and make bigger payments per month. Yeah, I just think building equity in your house, it's a good thing. Okay, so there are different ways, though, to pay a little extra. One thing that I don't know why I never did this, but I never did, even though I read about it for many, many years, is because I kind of didn't totally get it, I guess. But our mortgage was always due on the first of the month. Well, instead of paying your mortgage just on the first of the month, pay it every 2 weeks. So you're getting your paycheck. And so now, every 2 weeks, put it on your calendar, whatever, make a mortgage payment, a half payment. It doesn't have to be a whole payment, a half payment. So it seems like once a month you're just making one payment, but you're doing it every 2 weeks. Well, if you actually do it every 2 weeks, you will, by the end of the year, because there are 52 weeks in a year, let me do the math here, you will have made 26 payments by the end of the year, as opposed to if you just pay once a month, 26, I should say, half payments. So 14 full payments. Where if you paid on the first of the month, you'd only make 12 full payments. But the other thing with this is because you are paying it every 2 weeks, you are paying it before the interest has come due, I think, if I'm understanding it correctly. So it's sort of like what we talked about paying credit cards, before the, I can't think of the word for it, but so because you're paying every 2 weeks, you actually are paying less interest overall. And you end up making 14 payments in a year. So that's one way to help pay off the mortgage. I mean, I'm a big believer in trying to front load it. So if there is any way you can pay more in the beginning to get yourself closer to where your interest is lower, I think that's worth doing. Because once you get to a certain level, then you're paying more principal than you are interest. Whoops, up here. And then you don't feel as bad about it. What else? So there are these, I need a cloth or something, hold on. There are these, for first-time home owners or buyers. They have these grants you can get in certain areas. You'd have to look it up. But sometimes you can get a grant if you're a first-time home buyer to help with your down payment. And there are these state housing finance agencies. Every state has one, a housing finance agency that's legit. You can go look at and talk to them to find a legit lender for those kind of grants, and they'll list them sometimes. It's if you buy in certain areas or you're going to do upkeep, or sometimes it's just because, I don't know. But anyway, it's worth looking at. The other thing, if you're well, anytime you're getting a mortgage, you can shop lenders. You don't have to just go to your local bank and take what they give you. You can go to a few places and say, what are you going to give me? So just shop around if you need to. I mean, if you have like terrible, terrible credit and not much money to put down, there are like character-based lending where you go and take classes and you prove to them that you can pay down the debt that you have and that you're paying all your bills. And it takes some work, but they can give you loans through those too. So there are things that can be done. What have I left out? I don't know. I'm sure there's plenty I've left out. I can't think. Well, in the comments, please share if you have insights. It's hard, it's hard to, I never really told you about my loan. So I got this no doc loan that had very high interest. Well, what I considered fair, I think it was over 6%. It seemed high to me. And then my husband got sick and he can't work. And so I was running multiple businesses because I wanted to also, help be around my kids and everything. So that's when I really started to work from home, running businesses. And I never missed a mortgage payment, ever. I made every payment. And the interest rates went down like very low for a while. And so I went into my bank and said, can I just, refinance my mortgage to this lower interest rate? Well, apparently that's not how it works. They have to give you a brand new mortgage. It's not like they can just, I don't really. So they made me supply them with all my information. Well, I'm self-employed, and because of that, it's like you can write off parts of your house and parts, just all kinds of things. So your income might not quite match. You know what I'm saying? Because like part of my mortgage is written off as business expense legitimately. But it shows that you don't make as much. Does that make sense? But also I had no paychecks, so I didn't have anything like that to show them. But I've never missed a payment, and I bank with this bank, and they would not approve me to get a lower interest rate. I'm like, but I want it for the same amount of time, and I've never missed payment, so I can't, it doesn't make sense. Anyway, so that made me very angry, and I just said, okay, I'm going to put every bit of money that I have towards paying off my mortgage. And so I've never bought like a new car. I have all old, and I mean old, beater cars. And I like sell stuff on eBay and Marketplace, just whatever it takes to make payments towards my mortgage. And I paid off my mortgage just recently. I did it in 20 years and got it paid off. And I know that there are people who would say that was dumb. You should have put it into the stock market or whatever. But for my own peace of mind, I just wanted that to be done. Like, I want to know I own the house. And no matter what happens with health or whatever, it's like done. And the funniest thing is, you have to go in bank. I forget what, because of the last payment, you can't just write a check. You had to like wire transfer. I don't even remember exactly. But so I'm there getting it all done. I finish and the bank woman says, "Congratulations." I go, "Thank you." And she goes, "So if you'd like to take out a loan on your home, we have home loans, whatever." I'm like, what? Like, no. So that leads me to the very last, is that I'm telling you, since I paid it off, I get letters every day asking me to take out a loan on my home. I'm like, the whole point was I don't want a loan on my home. So you do have to be a little careful. Like, they will offer you what's called a HELOC, which is a home equity loan. What's the equity loan? Something credit. I don't know. Anyway, but the problem with it is, if you take out a loan like that just to like, they say it's for like, oh, put a new roof on your house or whatever. But it's tempting to take out a loan like that and use it for just like going on vacation or buying a new car or paying off your debt. And in a way, it's like, makes sense to take out a low interest HELOC loan and pay off a high interest credit card debt. But the only problem is, if for some reason you can't pay off that loan, the HELOC loan, your house is at stake. While a credit card loan debt, can be worked and they can't take your house away. But so I would just be careful. I would just make sure you know what you're doing before you do anything. I don't know. So my advice is definitely not what everyone's going to say. Like, a lot of people will say, don't pay off your mortgage. That's stupid. Da, da, da. So I'm just telling you that's what I did, but I don't think it's necessarily the right thing to do. But in my circumstance with, I just felt better about it. I just felt better. Because who knows what tomorrow holds. And I just want to make sure that I've got my house. So, I don't know. I can't think of anything else, guys. Yeah, and plus just having the ownership, it does make you feel good, I think. And I don't plan to sell it. I have a feeling I'll be in this house until forever. But who knows? Never know. Anyway, all right. Well, I know the minute I finish this, I'll be like, oh, I have more thoughts. So we have adjustable rate, fixed rate, FHA, VA, and USDA. We have collateral as your house. You will have to pay interest on the loan, and you'll pay towards a principal. There will be taxes and insurance. And even now that I have paid off my mortgage, I still owe taxes and insurance every month. So